What's up, YouTube? This is going to be a video on technical analysis, what it is, and how we use it to identify trading opportunities in the market. So if you want to learn technical analysis, this is the video for you. All right, we got to get the boring stuff out of the way before we get into TA, and that's the definition of technical analysis, okay? Technical analysis is a trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume, okay? Unlike fundamental analysis, all right, which attempts to evaluate a stock's business results, right, their earnings, their sales, technical analysis focuses on the study of price action and volume. If you didn't watch my last video, click below because you need to understand what a candlestick chart is to be able to read price action. Price action is the movement of a security's price plotted over time. And what do we do to plot that price action? We use candlestick charts. Price action forms the basis for all technical analysis of a stock, commodity, or other asset charts. And the way we use technical analysis and price action is recognizable patterns. So how is technical analysis used? So a prime example of technical analysis would be support and resistance. What you have here is a candlestick chart that is creating support and resistance. Now, what happens? Well, big money comes in, okay? Smart money, whales, all right? And they bought a stock at $100, somewhere way down here, right? They bought it at $100. Now the stock has traded all the way up to $200. This $200 price point now becomes a resistance because that hedge fund, that whale money that bought at 100 is now starting to sell, okay? So when the stock gets up to 200, they start to sell their positions, it becomes resistance, and it's plotted in price action on a candlestick chart, all right? Now, when that big money starts to sell, another hedge fund says, we like this stock, right? We want to buy the stock at $150. So when the stock falls down to $150, that hedge fund hops in and starts buying. Now, what happens when buying pressure hits a stock? The stock goes up in demand, it increases in price, comes back up to $200, and what happens? That hedge fund is selling their position because it takes multiple days for large money to exit or enter a stock position. So the stock gets sold off again, falls back to 150, and boom, another hedge fund is there to buy, back up to $200, boom, sell, back up to back down to 150, and buys. Now, technical analysis is used because at some point, one of these two institutional hedge funds is going to disappear, okay? This fund is either going to stop selling their position because they don't have it anymore, okay? Or buyers are going to start coming in and they're going to start pushing the price even higher because they want more of it, all right? Now, the opposite can happen as well, right? This guy can still exist selling the stock and the buyer can disappear or sell for a loss, which will lower the stock. These are called breakouts, all right? Support and resistance level becoming breakouts, and breakouts are tradable events. Not only that, but support and resistance are tradable events, okay? You short the stock when it gets to resistance, or you buy the stock when it gets to support. These are trading decisions based off of technical analysis. Also, breakouts are buyable events as well. You could either buy the breakout or you could buy the retest of the breakout as it creates new support and resistance. Markets at all times have ebbs and flows, going up, going down. A market isn't just, one price all the time, ebbs and flows. So the basis of technical analysis being that certain chart patterns have statistical probabilities of playing out. We see them repeatedly over and over again. A great example of this would be bull flags, bear flags, and pennants. We see these all the time. Now just imagine that these are candlesticks, okay? And a bear flag is when you get a sharp increase in price, right? Buyers come in, volume comes in, pushes the price up, and it hits a sell point, a resistance point where people start taking profit. And then you have people that could be late to getting into the stock, starting to buy and then sell, buy, sell, and then boom, you have a breakout of that bull flag channel. These are high probability patterns that play out in the stock market all the time. The reverse of that being a bear flag, right? Stock's getting sold off, somebody starts to buy, gets sold off, somebody starts to buy, gets sold off, okay? Buyers disappear, and the stock continues in a downtrend, all right? Bullish pennants, bearish pennants, similar. The way they set up, the way they create triangles, the way they create channels is how we identify them, okay? If you're interested in getting deeper into technical analysis, click the link in the below because I have a course set up on taking beginners to professional traders, all right? So if you're interested in that, check it out. Going into some more chart patterns, okay? Bullish pennants, ascending triangles, double bottoms. Some people call these double bottoms. I like to call it the George W because it creates a W on the chart. this is a beautiful setup to take because it shows that the stock has reacted off of support twice in the same area. It's not always the same area, but sometimes it can be. Perfect to get in on the second double bottom, or perfect to get in on the second double top. All right. All these patterns work in the opposite and inverse directions. Okay. Head and shoulders, another one that sets up all the time. I don't like to trade head and shoulders, but they're out there. You'll see them form in the stock market charts all the time. Okay. Descending triangles, another great strategy to do. Bearish pennants, bearish flags, bullish flags. A lot of traders out there and YouTube channels make technical analysis very hard to understand. All technical analysis is charting price action and patterns and making our investment decisions based off that. Now, your methodology, your trading strategy, your trading rules, your playbook, your psychology, it all starts to come together. Technical analysis is only, a small aspect of trading. Psychology is 80% of trading, or I think technical analysis is probably only 20% of trading. Really, the patterns are the patterns. They're there every day. They're going to be setting up. They're going to work. They're not going to work, right? How you react to that and how your trading psychology affects those decisions is going to be 80 to 90% of your trading. So if you're interested in trading psychology, I got a bunch of good videos on this YouTube channel. Guys, I hope you found value in this technical analysis video. It's very short and sweet and to the point. If you did, please like the video. Please click the subscribe button. Hit the bell notification that you can stay tuned for future videos. And I will see you on the next one.